In the last chapter, we learned how to read market structure. Now we use that structure to answer a bigger question. What kind of environment is price trading in? Before a trader thinks about entries, indicators, or setups, they need to know whether price is trending, ranging, or unclear. The same idea can work well in one environment and fail badly in another. That is why trends and ranges come before strategy. Market condition is the background behind every trading decision. If price is trending, the market is showing directional pressure. If price is ranging, the market is showing balance. If price is unclear, the best decision may be to wait. Beginners often skip this step. They see one candle, one level, or one indicator signal and react immediately. But a signal without market condition is missing context. A trend is a market that is generally moving in one direction. An uptrend is built from higher highs and higher lows. A downtrend is built from lower lows and lower highs. The word generally matters. A trend does not move in a straight line. It moves, pauses, pulls back, and then tries to continue. The job is not to expect perfect movement. The job is to read whether directional structure is still holding. A healthy uptrend does not mean every candle is green. It means buyers keep defending pullbacks. Price pushes higher, pulls back, and then finds support above the prior important low. Then price attempts to reach higher again. The important clue is not that price never falls. The important clue is that the pullbacks are not breaking the structure that made the uptrend valid. A healthy downtrend does not mean every candle is red. It means sellers keep defending rallies. Price pushes lower, bounces, and then fails below the prior important high. Then price attempts to reach lower again. The bounce is not automatically a reversal. The key question is whether lower highs are still forming and whether sellers are still controlling the structure. Most trends are built from impulse legs and pullbacks. The impulse is the move in the trend direction. The pullback is the move against it. In an uptrend, impulses push higher and pullbacks dip lower. In a downtrend, impulses push lower and pullbacks bounce higher. Beginners often confuse pullbacks with reversals. A pullback is normal, while trend structure remains intact. A trend looks stronger when impulse legs are clean and pullbacks are controlled. In a strong uptrend, price may spend more time pushing higher than pulling back. In a strong downtrend, price may spend more time pushing lower than bouncing. Strength can also show up when price breaks prior swings with conviction. This does not mean the move will continue forever. It simply means the current directional pressure is still obvious enough to respect. A trend can weaken before it fully breaks. You may see smaller pushes in the trend direction. You may see deeper pullbacks against the trend. You may see price taking longer to reach a new high or a new low. Weakness does not always mean reversal. It means the trend deserves more caution because the clean directional pressure is no longer as strong. A trend begins to break when the structure that supported it is no longer holding. In an uptrend, that may mean price breaks below an important higher low. In a downtrend, that may mean price breaks above an important lower high. One break does not guarantee a new trend. It only tells you the old read is damaged. After that, price may reverse, move sideways, or become unclear for a while. A range is a market that is moving sideways instead of trending cleanly. Price keeps reacting between a similar high area and a similar low area. The high area acts like resistance. The low area acts like support. Inside a range, the market is not showing clean directional control. It is showing balance, disagreement, and back and forth movement. A basic range has 3 zones. The range high is the upper area where price struggles to continue higher. The range low is the lower area where price struggles to continue lower. The midpoint is the middle of the range. Beginners often get chopped up in the middle because price can move both ways. The edges usually matter more than the middle. The edge of a range is where balance gets tested. At the range high, buyers try to prove a breakout. At the range low, sellers try to prove a breakdown. If price rejects the edge, it may rotate back inside. If price holds beyond the edge with strength, the range may be ending. The edge is where the next story often begins. Ranges often create false breaks. A false break happens when price pushes outside the range but cannot continue. Price may move above the range high, attract breakout buyers, and then fall back inside. Or price may move below the range low, attract breakout sellers, and then return back inside. This is why beginners should be careful with the first move outside a range. The important question is whether price can hold outside the range, not just touch outside it. A market can shift from trend to range. This often happens after a directional move starts to lose energy. The impulses get smaller. The pullbacks get deeper. Price stops making clean progress and begins overlapping in the same area. At that point, forcing trend logic can become dangerous because the environment may no longer be trending. A market can also shift from range to trend. This happens when price leaves the range and begins building directional structure again. A strong break from the range is only the first clue. The next clue is whether price can hold outside the range. Then you look for new higher highs and higher lows, or new lower lows and lower highs. The break matters more when structure begins to follow it. Many trading mistakes come from using the wrong playbook. Trend logic expects continuation. Range logic expects rotation. If you use trend logic inside a choppy range, you may buy highs and sell lows. If you use range logic inside a strong trend, you may keep fighting the direction of pressure. The goal is not to predict perfectly. The goal is to match your thinking to the environment in front of you. A simple beginner workflow can be 4 steps. First, mark the obvious swing highs and swing lows. Second, decide whether price is trending, ranging, or unclear. Third, identify the most important zone for that condition. In a trend, that may be the swing that keeps the structure valid. In a range, that may be the high, the low, or the midpoint. Fourth, ask what would prove your read wrong. Here are common beginner mistakes with trends and ranges. They call every move a trend. They ignore the difference between a pullback and a reversal. They trade the middle of a range as if it is clean. They chase the first break outside a range without waiting for proof. They keep using the same idea after the market condition has changed. When the chart gets confusing, simplify the condition first. Here's the chapter in one recap. A trend is a market that is generally moving in one direction. An uptrend holds higher lows. A downtrend holds lower highs. Trends are built from impulse legs and pullbacks. A range is a sideways market that reacts between a high area and a low area. The middle of a range is often messy, and the edges are usually more important. Markets can shift from trend to range, and from range to trend. Your read should change when the market condition changes. The goal of this chapter is simple. Do not treat every chart the same. First, decide whether the market is trending, ranging, or unclear. Then decide which levels matter inside that condition. That one habit can remove a lot of confusion. In the next chapter, we build on this with support and resistance.